I haven't been assigned once all year on that particular strategy. So it's been really good. It's about a 75% return on just that strategy this year. That's actually been my highest performing strategy.
With covered strangle, you can make extra money on stocks you own. Either the price goes up or down. My guest to discuss this strategy is a high school chemistry teacher as well as a dedicated options retail trader. Welcome, Lance Kaminsky.
Hi, everybody. Thank you, John, for having me. Appreciate this and interested in talking about the covered strangle.
But just tell me how you combine being a high school teacher and options trading.
Yeah, it's interesting because I teach full time chemistry, some physics, and obviously I'm pretty busy with about 110 students. So I do relatively passive trades that usually go pretty far out in time as well. So I don't have to watch the market every minute of the day. I typically do stuff with relatively lower implied volatility. They're not going to be very dramatic moves on most of the positions. Occasionally, I will do some on a little bit higher IV, possibly riskier trades, but most of my accounts are very conservative and very low, ups and down moves on those positions.
Have you been trading for a long time?
Yeah, pretty long. I've been mostly a investor. So in the U.S., we have a Roth IRA for our retirement accounts, and I've been doing that for 18 years now and been maxing that out. And just a little segue into the covered strangle. I've been buying and holding for many years. Eventually, I had 100 shares of different stock. And then I noticed I could sell a covered call against it, take in some premium when already have a good cost basis. And then I went into the cash secured put side where you could, get another 100 shares of stock at a lower price. And then just notice you could combine both of those together and then have a covered strangle, which we'll talk about soon.
So let's define very briefly first what is a covered strangle.
Okay, so first, a regular strangle without being covered is when you're selling a call and selling a put. A covered strangle is when you already hold 100 shares of stock and then you sell the call and sell the put. By holding the 100 shares of stock, it would be a covered call. So if the price of the underlying goes up dramatically, you're still okay because you have those 100 shares of stock. And then you have a short put as well. You're willing to take in another 100 shares of stock and obviously be okay with that if you get it. So it's essentially a covered call and a short put combined together.
And so it is composed of the two words, the strangle and the covered. And the strangle is the two selling shorts on each side.
Exactly.
Let's go into how you set up this trade.
Sounds good. So essentially, you're going to buy 100 shares of stock first. Typically, you want to be selling some if you're relatively conservative, buying stock that you're more bullish on in the long term. So you're going to buy 100 shares of stock first. Then you're going to sell a call. And there's a lot of flexibility in where you sell the call, which would make this a covered call. You could sell them a little bit in the money. So, for instance, if you buy a stock at $30 a share, you could possibly sell a call at $29 a share, and then you take in a lot of premium that way. It also helps reduce your cost basis, and if the stock happens to drop a little bit, then you're still usually okay. You can also sell them out of the money. And in that case, you get more capital gains. So again, you bought the shares at $30, and let's say you sell a covered call at $32 a share. Then if the stock goes above 32, you would make the difference of $2 or $200 for the 100 shares, and that's in the capital gains. And then with that, you're going to sell a put. Typically, I'll sell a cash secured put. So let's say I sold a 28 strike, then I'm going to have $2,800 available from my brokerage. So then if I happen to get a sign on that, then I have another 100 shares, then I would have 200 shares at that point.
And I guess we have an example of a trade just to give a bit more meat to it.
Yeah. So if you look at the slide here, SCHD, that is the Schwab, pretty much a high yields on dividend ETF. It's not a very dramatic up and down ETF. It stays in a relatively tight range in most cases and pays good dividends that grow. So this is an ETF that I own a lot of shares of in my Roth IRAs, but I also do the covered strangle with some of my shares, not all of them. So look at the example here. The second line, I bought 100 shares at 28.39. And then on the top line, I sold a 29 call, so a little bit out of the money. Took in $20 on that covered call. And then I also sold on the third line a 28 cash secured put, and I took in $27 for that. So overall, I took in 20 for the covered call, 27 for the cash secured put. It's an extra $47 in premium that I took in. And if it goes below 28, I'm perfectly fine with buying another 100 shares at that 28 strike price because then I bought another 100 shares at a lower cost than where I previously bought them at the 28.39.
And if you dig into the cost basis, I think you have here you are calculating that. How do you calculate the cost basis of this trade?
Yeah, good question. So I bought the 100 shares at 28.39, and then I'm going to subtract the premiums I took in. So I took in zero point 0.2 or $20 on the covered call, and then $23 on the cash secured put. And then you're just going to subtract that from the initial 100 shares that you bought. So that means the cost basis would be 27.96 in this case.
And then of course if you have several rounds of it, it will be lower and lower.
Yeah, so if we don't go below the cash secured put and we don't go above the covered call, then I'll just do that same thing again. I'll sell another covered call, sell another cash secured put, take in premium on both sides as well, and then lower your cost basis even more.
What is typical your DTE for the call and the put you sell?
Yeah, so again, I'm pretty busy teaching all day. So I typically look around a month out where I'm going to sell the call and the put. And then I just let it sit there pretty much every time. I'm going to see what happens at expiration. And we'll go over the slides later. At expiration, I'll either re enter the position or I'll take another 100 shares and then sell covered calls against those as well.
We'll get to the management, but let's start now with the underlyings. So how do you pick your underlyings?
Yeah, so I typically want ones that aren't having dramatic up and down moves. SCHD is a good example of that. They're very blue chip type companies. They pay good dividends that has been growing over many years. So you only want to do this with stocks or ETFs. And you could even do this with futures. You could do this with like MES futures or ES if you have a large account. And you need to be willing to hold them for a long time and have at least 200 shares of stock if you're doing stocks or ETFs, or at least two contracts if you're doing the futures contracts.
And what about managing it? As you said that you usually go 1 month out. You don't want to do too much, as I understand, during that period. But what are the scenarios? Let's go through the scenarios. What can happen in the risk management? I guess the one scenario is if the price ends up between the shorts, right?
Exactly. So when the price ends up between the covered call and the cash secured put, then both of those premiums or both of those option contracts will expire worthless. You get to keep the full premium that you did before you entered the trade. And then I'm just going to do the same exact thing again. I'm going to sell another call, usually at the initial price or higher. If it moves a little bit up, I might look to sell a new covered call a little bit above the previous one. And then you could get even more possible capital gains if it runs up. And then I'm going to sell another cash secured put. So essentially just recycling and entering in both of those positions just like I did the first time.
And how many times you can do this?
I mean, you could do this for infinity theoretically. If you never get a sign on the covered call or the short put, you could just keep taking in more premium month after month and then lower your cost basis. And again, ideally, you want this with positions that you're very long term bullish on. So you will see a uptrend in the position. So then you could just keep going with the price going up. So let's say SCHT just slowly goes up. You could sell the covered call higher and higher and then possibly lock in a really big gain eventually if the covered calls go away.
In theory, but how often does it happen in practice?
In terms of the covered call being assigned and you lose your shares, not too frequently. I typically go a pretty high strike price. I usually go out of the money and I'll typically look around a zero point 0.1 to zero point 0.2 delta on the covered call side. So I'm willing to be a little bit patient. I'm not trying to make a ton of money on the premiums necessarily, but I want to be able to ride up with the position.
Okay, so let's see now. Let's say now that the price dumps and your short put is breached. What do you do then?
All right, so if your short put is breached at expiration, again, I wait until expiration. I'm not going to manage before that because I'm okay with what happens in any of these scenarios at expiration. So if you get assigned on your cash secured put, you would then get another 100 shares of stock or ETF. And then you already had 100 shares. So now you're at 200 shares of stock. At this point, I'm usually going to be selling two covered calls, but I want to make sure that those covered calls are at least above my cost basis because if the position rides back up again, you want to make sure you're not locking in a loss at that point. So if it drops a little bit, let's say I sold a 28 put on SCHD and we get assigned at 27.5, so not a dramatic difference. At that point, I will probably sell the two covered calls around 29 or so I could get back in that upswing. If the position happens to drop a lot, let's say it goes to 24, 23, then I wouldn't be selling the covered calls right away because the premiums wouldn't be worth it. And I'm just willing to wait it out a bit just to get that eventual recovery and also take in dividends while I'm waiting.
But if the price keeps falling in every round, you sell another cash secured put, but I guess there is a limit to how long you will keep selling new puts and add to your stocks.
Yeah, that is possible. It hasn't happened in the last year and a half with me now. There, you could do a stop loss, track your cost basis, see how much down you are, and obviously know how much you're willing to lose before you start this. I'm perfectly okay with buying a CHD and waiting for a recovery, but it's definitely a good management to be able to have a stop loss in place if you're worried about it just continuing to drop.
What then if the short call is breached? What is your strategy then?
So if the short call is breached, you're actually at the maximum profit at expiration because at that point you're going to be gaining usually some capital gains on your shares, especially if you sold the call out of the money. You also keep both sides of the premium. You're keeping the covered call, keeping the cash secured put premium. And then if it didn't run up really high, but let's say it just barely breached your short call, in that case, I would usually just restart the strategy, buy another 100 shares again, sell the hash shared put, sell another covered call even higher than it was before.
A lot of people are familiar with the covered calls strategy, and this has a lot of similarity. How would you compare this strategy with covered call, in terms of, let's say, risk profile and how easy or difficult it is to manage, etc.? Why should people jump from covered call to covered strangle, for instance?
Okay, good question. So covered calls are a pretty conservative strategy. When a lot of people are talking about options, they think, oh, options must be very risky. But selling a covered call is actually more conservative than holding 100 shares of stock because you're taking in that premium. as the position moves. So I would start with covered calls in general if you're brand new, or you could intermediate to doing these type of trades, and then think about selling a cash secured put just separately on the side. If there's a stock that you like, but you think it's a little bit overvalued, you could sell a cash secured put at a price that you're willing to and be happy with getting the 100 shares of stock. And then you're essentially just combining both of those strategies together. So, again, for beginners or intermediates, I would focus on just one side, just do covered calls for a while, understand how the mechanics work, and then you could just do cascade puts. And then eventually, if you want to, you could combine both together.
What is the worst that can happen with this strategy?
So the worst that could happen is the stock just continues to drop and just keeps going down, down, down. At that point, you're not going to be really wanting to sell covered calls because the premiums will be way too low where you had your initial entry. And theoretically, you could have a pretty big loss if the position goes down really far. And that's why this is one of the keys, is to only do this with stocks or ETFs or even futures that you're willing to hold for the long term. So you might have to wait a while if you get a big drop for that eventual recovery.
If you're going to put this on a risk profile, with the 1 being the very low risk and 10 being very high, very risky as a strategy, options trading strategy, where would you put it compared to other option strategies?
So, based on very conservative or very strong long term stocks, I don't think it's very risky. I would probably put it around a 3 or a 4, just because it's going to have that eventual recovery. Like if you buy SCHD, those are some of the strongest fundamental companies in America. And over the long term, these will be growing as the US economy grows. However, if you're doing this with riskier positions, so big moves up and down, then it would be a higher risk trade because of that big drop that you might have that we just talked about. At that point, it might be around an 7 or an 8. Because I'm not going to say 10 because you are taking in premiums on the puts and the call sides.
Do you try to avoid earnings with this strategy?
For SCHD, it's not going to be much of an issue because earnings come out frequently and there's a lot of different stocks. If it's one individual stock I'm doing, I usually would wait during earnings to sell any options. And then when the earnings are done, I'll go back into selling the call and the put. But I usually frequently do this with ETFs over individual stocks.
How do you measure the results?
Do I measure the results?
Yeah, how do you measure them?
So measuring the results is I'm going to look at where I bought the shares of stock. I'm going to be adding up the total premiums on the calls and the put sides. And then eventually, when the covered call goes away, I'll look at any possible capital gains and then essentially add up all the premiums collected plus the capital gains and then divide it by the total amount of money that you needed to do the trade.
And now I'm sure that many people are interested in what have been the results.
Yeah, results have been pretty good in general. I've only done the covered strangle for about a year and a half with stuff like SCHD. I've been doing stuff on MES, the futures for SPY, and that one has been very good just because we've been in a very bullish market the last year. So in that one, I'm actually selling 2 short puts. I'm going to sell one quite a bit below, near the expected move, and then I sell another one even lower than that. On those, I close them out at 75% profit of the premium received. So I'm not waiting to expire on those. And I haven't been assigned once all year on that particular strategy. So it's been really good. It's about a 75% return on just that strategy this year. That's actually been my highest performing strategy. I don't
75%. That's very good.
It's really good. I only do that with a very small percent of my account because you got to be careful with futures, especially if you get a sign on a futures position. MES, you can lose $5 every point it drops. So
So,
it's
but
been really good.
75% of what? Of your account value?
It's a very small percent. I think it's about 2% or so of my total account. Yeah, I stay mostly conservative, so most of them are buy and holds. For SCHD, for example, I'll do a few of the covered strangles, but I hold a lot of shares as just long term buy and hold, and I don't do any options with those.
So let's sum up in a couple of sentences this strategy and who is it for? Who would is it a good fit for? What type of trader?
Yeah, so I think covered strangle is a very flexible strategy. You could sell your strike prices, again, your covered call, you could sell in the money. You could sell the short puts really far away if you want to. So once you get the mechanics understood, it's a very flexible strategy and it would be good for traders that are okay holding 100 shares or holding half of a lot, so to speak, and then being okay taking in the other half lot at a lower entry point. And then also, if you want to be conservative, just sell the call, sell the put, and then if it goes away and expires, you usually make a very good return off of it anyway.
Tell us a little bit about you, where people can connect with you and learn more from you.
Yeah, so I run thetatraders.com. If you see in the, oh, there we go, in the bottom over here. So I do many different types of option trades. I do a lot of credit spreads where you sell a put and then buy a put right below it. I do the covered strangles. I'll occasionally do some zero DTE on SPX. And then I do some futures trades, futures strangles. And then quite a bit of trades. And I am a teacher, so I've been able to help beginner, intermediate people understand a lot of the mechanics behind the trades and why we take trades the way we do.
And you're based in Texas, I understand.
Yeah, in Texas. It's a bit hot up here. I know in Norway it's a bit cooler, I think.
It's already dark. It's 5 p.m.
Yeah. Do you get any sunlight around now? Just a few hours, maybe?
During daytime, maybe if you're lucky.
That's good.
uh,
Are you guys able to see the northern lights at all?
well, it's mostly in northern Norway. I live in the southern part, but actually, the last year it's been you have sometimes been able to see it in the southern part as well,
Oh,
which is
awesome.
quite exciting, actually. Yes.
Very nice. I was talking about
And
that in my chemistry class about how electrons move to different energy levels and it releases the different colors of light. But it's definitely a sight to see.
it is very
Yeah.
fascinating. Lance, thank you very much for joining and for explaining this strategy so well. I really appreciate it.
Thank you very much, John. It was great talking with you, and hopefully, everyone that watches understood the strategy and got some benefit out of it.
Thank you very much.